It's really quite striking, the difference between what we're seeing in Asia Pacific and the rest of the world, particularly in a lot of the emerging markets, but also in some developed economies like the US. You've seen a significant acceleration in what's known as core inflation, particularly categories that involve reopening related prices bouncing back very sharply as economies reopen and reflecting demand side pressures where the supply side hasn't caught up yet. We've also, of course, seen a significant rise in global commodity prices. And in the rest of emerging markets, and I'm thinking of Latin America and CEMEA regions, you've often seen very significant rate hikes by central banks as they try to catch up to the acceleration in inflation. And that's not something we've seen so far in Asia Pacific. I think there are two main reasons for that. One is the reopening has lagged somewhat in Asia. Virus-related restrictions remain a bit higher and are coming down more cautiously. So that's tempered the demand side response. And then secondly, food prices, which are very significant in EM, really have been quite tame in Asia compared to the rest of the emerging world. And that reflects, climatic conditions like the so-called La Nina cycle, as well as some country-specific factors like pork prices in China. So that's given central banks in this region a bit more time to plan their policies, and we think that'll mean a more gradual interest rate tightening cycle in this part of the world. But we still need to keep an eye on the reopening pressures in Asia Pacific, particularly in places like Southeast Asia in the first half of next year as they reduce restrictions and activity starts to rebound.
But the world is watching what the Fed does in terms of its communication on this front. Do you expect, so I get the part about, they're going to be looking at a gradual rate hiking cycle, but will it be a shallow one? Will it be a sharp one? Because now the conversation is shifting towards that.
Most views about the so-called terminal rate, how high can the Fed take the rate in this cycle, tend to be relatively low, 2-3% maybe. We think they can, as we get towards the end of the cycle, overshoot what people might call a neutral rate or R star, as it's sometimes referred to. But we ultimately are skeptical that the Fed will want to go quickly in late 2022 or 2023. They already have the taper planned out, which will finish presumably in the middle of next year. There is some risk they start hiking mid to late 2022, but they will, we think, have some time to get to a neutral rate if that happens, and probably will want to assess as they go along the progress of financial conditions and of inflation. And while inflation is very elevated right now, we think on a year-over-year basis in the US, it's likely to come down somewhat in the second half of next year, which should also take some of the pressure off the Fed.